Yesterday afternoon, Iran launched a series of missile strikes targeting several U.S. allies in the Middle East. Crude oil prices reacted immediately, surging back to levels not seen since late May, as the energy market priced in the sudden escalation of conflict. Historically, a surge in energy costs of this magnitude forces a massive rotation in global capital, as investors typically dump bonds in anticipation of rising inflation. Yet even with the Middle East in turmoil, U.S. mortgage and bond market are holding their ground. They have entered a stubborn stalemate, refusing to follow the volatility seen in the oil pits. To understand the current trajectory of mortgage rates, we have to look at the baseline pulse of the 10-year U.S. Treasury yield. Currently, those yields are trapped within a very specific corridor, a rigid floor at 4.43% and a heavy ceiling at 4.52%. The yield is ricocheting between these two boundaries, absorbing external shocks while remaining unable to sustain a breakout in either direction. This lack of movement indicates that market participants are coiled with immense tension as the pressure builds against these 9 basis points of resistance. At the morning bell, the 10-year yield ticked up roughly 3.5 basis points to 4.485, sitting in the upper half of that narrow corridor. This pushed mortgage-backed securities down by a quarter point, creating immediate downward pressure on loan pricing for homebuyers. Despite that dip, bond yields are actually holding much lower than the current spike in oil prices would normally suggest. Under the standard rules of oil price correlation, yields should be skyrocketing alongside crude as the market prepares for an inflationary shock. Instead, the bond market is functioning as a massive dampener, resisting the geopolitical signal and keeping yields contained within the established range. This focus on the conflict has made the market nearly indifferent to the domestic data that was originally expected to drive today's session, specifically the ADP employment numbers. The labor report hit its targets with surprising accuracy, coming out almost exactly as the experts predicted. In a typical week, this would be a major market catalyst, but today, trading desks didn't even flinch. The bond market offered no notable response to the figures. That silence highlights a market that is looking past standard economic indicators and focusing almost entirely on the headlines coming out of the war. When geopolitical stress reaches this level, baseline economic reports often lose their influence, as traders wait to see how the threat of conflict will reshape the global landscape. While the war provides the background noise, the market remains paralyzed within its narrow range, holding its breath for a definitive signal. That signal could arrive at exactly 10 a.m. Eastern Time with the release of the ISM Services Report. The ISM report carries significantly more weight than the morning's labor data, and it is one of the few reports this week with the potential to break the current stalemate. If the report shows unexpected service sector strength, it could combine with oil panic to fracture that 4.52 ceiling, spiking rates. Conversely, a weak report might counteract the war narrative, dropping yields back toward the 4.43 floor and providing mortgage relief. Traders are watching the clock, waiting for the second the data hits the wires to see which way the pressure will finally vent. In this environment, a mundane spreadsheet arriving at 10 a.m. has become the primary detonator for mortgage rates, carrying more immediate influence than even the morning's missile strikes.